We are talking about the market crash with the portfolio you have today. If that question makes you pause, you're not alone. Many investors don't fully grasp the delicate dance between risk and reward and how their choices today shape their financial peace of mind tomorrow. In this episode of the Capital Breakdown, we're diving deep into risk management and asset allocation, two foundational ideas that help build a balanced portfolio. By the end, you'll understand how to think about spreading your investments in a way that fits your goals and comfort with risk, so you're better prepared for both the ups and downs of the market. Let's break it down. The problem or confusion. Most people think investing is just picking winners, like buying a stock they hope will skyrocket or chasing the latest hot trend. But that's like putting all your eggs in one basket and crossing your fingers. The problem is, markets move in cycles, and what looks like a sure thing today can be a roller coaster tomorrow. Imagine you're driving a car and only focusing on speed without paying attention to brakes or steering. That's how many approach investing, ignoring risk and volatility. This can lead to sleepless nights, panic selling, and missing out on long-term growth. So, how do you build a portfolio that lets you keep calm, stay invested, and still pursue your financial goals? That's where risk and reward come into play. The core concept explained. At its core, risk versus reward is about balance. Think of your portfolio like a garden with different plants. Some are sturdy perennials. These represent safer investments like bonds or cash equivalents. Others are vibrant flowers that bloom beautifully but need more care and can be more sensitive. These are stocks or real estate. Risk is the chance your investment's value will fluctuate or decline, while reward is the potential growth or income you might earn. Asset allocation is simply how you divide your money among these different plants to create a garden that matches your appetite for risk and your financial timeline. If you're young and can weather storms, you might plant more flowers. If you're closer to needing your money, you might focus on the sturdier plants. It's about mixing and matching to sleep well at night. Core concept explained continued. Let's make it even simpler. Imagine your money flows through different pipes. Each pipe leads to a different investment type. Some pipes are wide and steady, but slow, like bonds, giving you a steady trickle of income, but limited growth. Other pipes are narrower, but faster, like stocks, offering more growth, but with ups and downs. Spreading your money means not putting all your water through a single pipe. If that pipe clogs or bursts, you lose it all. Instead, you allocate your water so that your overall flow stays consistent, even if one pipe has trouble. That's how diversification works. It reduces the risk that a single bad event will drain your entire portfolio. How it actually works. Behind the scenes, your money moves through a system involving investors like you, fund providers who create investment products like ETFs and mutual funds, brokers who facilitate buying and selling, and regulators who set the rules to protect everyone. When you invest in a broad index fund, your money pools together with many other investors' money to buy slices of hundreds or thousands of companies. This pooling helps spread risk. But there are costs, like management fees and trading expenses, that chip away at returns over time. Also, market prices move based on supply and demand, economic data, corporate earnings, and investor sentiment. Understanding this ecosystem helps you appreciate why staying invested and diversified can smooth out the bumps rather than chasing quick gains. How it actually works. Continued. Regulators play an important role by enforcing transparency and fairness, but they don't protect you from market risk. That's on you. Brokers may offer leverage or margin, which can amplify gains but also losses, so they require careful consideration. Fund providers vary widely. Some focus on passive strategies tracking broad indices, while others actively manage portfolios trying to outperform the market. Each choice carries different levels of risk and fees. Knowing how money flows and what fees you pay helps you avoid surprises and better evaluate your options. This understanding is the foundation of risk management, being aware of where your money goes, what might affect it, and how to keep your portfolio aligned with your personal goals. Simple, concrete examples. Let's look at two examples to bring this home. First, imagine someone investing a fixed amount every month into a broad market index fund. This approach uses dollar cost averaging, buying more shares when prices are low and fewer when prices are high. Over time, this smooths out the ups and downs and builds wealth steadily. Emotionally, it's less stressful because you're not trying to time the market. Contrast that with someone who buys a single speculative stock hoping for a big payoff. That stock might soar one week and plummet the next, causing emotional whiplash. Without a diversified portfolio, a bad outcome here could mean a significant loss. The key difference is in spreading risk and managing emotional reactions, which often lead to better long-term outcomes. Simple, concrete examples continued. In the first scenario, the investor's portfolio might include a mix of stocks and bonds, gradually growing and adjusting as they age or their goals change. This mix helps them stay invested through market volatility without panic selling. In the second, putting too much into one stock is like betting the farm on one horse. You might win big, but you might also lose a lot. Both approaches involve risk. But the first is more about managing risk through diversification and time, while the second leans on speculation. Understanding these mechanics helps you recognize why a balanced portfolio isn't just a nice idea, it's a practical way to navigate uncertainty. Risks, traps, and common mistakes. Where do people usually get tripped up? One big pitfall is chasing hot stocks or sectors without considering how much risk they're taking on. Concentrating your portfolio in a single stock or industry can lead to big losses if that area stumbles. Another trap is leverage. Borrowing money to invest can magnify gains but also magnify losses, potentially leading to debt. Volatility can be scary, but it's a normal part of investing. The real risk is panic selling during downturns, locking in losses instead of holding for recovery. Time horizon matters too. If you need your money soon, you want less risk. Patience and realistic expectations are your best friends here. Investing is a marathon, not a sprint. Risks, traps, and common mistakes continued. Another common mistake is neglecting to rebalance. Over time, some investments grow faster than others and can throw your allocation off balance, increasing your risk without you realizing it. Regularly reviewing and adjusting your portfolio keeps your risk in check. Also, ignoring fees can eat into your returns. Low-cost funds often make a big difference over decades. Lastly, relying solely on past performance as a predictor can be misleading. Markets evolve, and no one can predict the future with certainty. Recognizing these traps helps you build better habits and avoid pitfalls that can derail your financial progress. How to think about this tool. Risk and reward management isn't just about picking investments. It's part of your bigger financial picture. Before investing, it's essential to have an emergency fund to cover unexpected expenses, so you're not forced to sell investments at a bad time. Budgeting and managing debt also set the stage for effective investing. Your portfolio should align with your goals, whether that's buying a home, retiring comfortably, or funding education, and your timeline for those goals. Risk tolerance is personal and can change with life circumstances. Remember, investing is one tool among many, and balancing it with solid financial habits creates a stronger foundation for long-term success. How to think about this tool continued. Think of your portfolio as a dynamic tool that you adjust as your life evolves. Younger investors might lean more into growth with higher risk tolerance, while those nearing retirement usually shift toward preservation and income. This doesn't mean avoiding stocks entirely, but balancing them with safer assets to reduce volatility. And no matter your stage, regular check-ins help you stay on track and adapt to changes in the market or your personal life. The Capital Breakdown encourages you to look beyond short-term hype and focus on principles that build resilience, so you're prepared for whatever the market throws your way. Recap and educational disclaimer. To wrap up, remember these key takeaways. First, risk and reward go hand in hand, and managing that balance through asset allocation is crucial for building a portfolio that fits your goals and comfort level. Second, diversification helps smooth out market ups and downs, reducing the chance that one bad investment derails your progress. Third, investing is a long-term journey requiring patience, regular reviews, and realistic expectations. This episode of the Capital Breakdown is for education only, not personalized financial advice. Always do your own research and consider talking with a qualified professional before making investment decisions. Thanks for joining me today. Here's to building a balanced portfolio and sleeping well through the market storms ahead. Thanks for watching the Capital Breakdown. Remember, this is education, not personal investment advice.